the world order is shifting.
Iran conflict was not on my bingo card.
This dynamic is causing a big liquidity crisis.
It's amazing that more natural gas is moving out of Houston than any other port.
$6-8 a gallon for gas. Like, I'm not driving my truck now because it's too expensive.
Nobody knows what's going on, what's happening, what's around next week, next month, next year.
Demand for affordable housing continues to grow.
People that own assets are going to continue to do very well. People that don't are going to continue to get squeezed by inflation.
All right, welcome back to another episode of the Cash Flow Quest. We got a panel going here. Tide Eldridge, Ben Schuster, Morgan Hampel. He's filling in for Jen. We've been busy, so apologies for the delay in getting another episode back online. We had several things we were working on using the studio. We've been developing a lot of things, including the Investor Circle, which is our online platform to engage fully with all of the insights that we work, the current deals we're doing, kind of the overall investment thesis, a lot of our thoughts on the space, what we look to push into and improve on the mobile home park operations. And then we had an in-person first annual investor summit at our hangar here in San Diego.
Really cool.
Super fun. So it's been a lot of good things going, a lot of growth, a lot of great investor conversations.
Mm-hmm.
We got a big deal we're working on. Today we're going hard on the earnest money of that deal, so we're going to be in full pursuit. So welcome back. We have some good topics. A lot of things have been moving on the market side too, including rates in the wrong way. And so there's kind of a looming recessionary,
Bench.
yeah, like tint
Vibe.
and we were not a fan of, as people that are typically optimistic in general. And so, so we're going to kick around interest rates. What the heck's going on? That's kind of a weird one. So we'll do our best to figure out and for, kind of kick off what we think and what we're going to do to hedge. And then some of the interesting dynamics as that discussion comes up, and it's becoming more regular on our investor calls. We started to pull into a couple layers of the onion on what do we think mobile home parks are going to do in a recession? If it happens, where do you want to be in the country? And so we've been pulling some good data. So we have some fun things to share. Probably going to try to keep it, 45 minutes or so. So let's kick off with interest rates.
Yeah. So interest rates, they were starting to balloon up, and there was a lot of chatter that there was the Trump put at 4.5, and that if interest rates, let's just talk about the 10-year right now, if that the 10-year approached 4.5, there was a lot of chatter in the market that Trump would pull out of Iran, pull out of this war, because he did not want interest rates to continue to climb. And it blew past 4.5 and it's touched 4.7. Today it's like in the 4.5, 4.58. So not good. The equity market sold off a couple percentage points over the last couple of days. So nothing major. But I think when you see the 30-year approaching, call it 2007 highs, and then you start to look at the 10-year Treasury sitting at like a 4.5, 4.6, 4.7, it's kind of going the opposite way of where the Fed was trying to go, as we were going into an easing environment where they were cutting the short end of the curve, the Fed funds rate, and they held for some time. We have a new Fed chair officially. And then you had this war that broke out that caused oil prices to spike. You had CPI last month that was like 3 point something, 3.1, I believe it was. And so all the fears right now are on inflation that's getting driven by the war, by the Strait of Hormuz, by oil prices, and then leading into not only oil, but all the costs that get rolled up into oil in terms of inflation, as well as a fertilizer, which we're going to have a shortage of fertilizer that they're expecting for this summer. So they're factoring that food costs are going to go up. And Heather Loomis, who was here on Friday and spoke all about the market, I had the pleasure of interviewing her. She's just so wicked smart. She talked all about this, and her thoughts were that rates are going to go up before they go down. And she said that in a lot of, more eloquently than I could. But if I could summarize, what we kind of talked about on Friday kind of showed through a little bit Monday, Tuesday, today's Wednesday, in that if the Treasury starts to run, I think that there's going to be a large sell-off and a lot of pain that's going to come through on the market. First, you'll see it on the equity side. So you'll see it in the stock market first, which is always a first mover. And then if all that does happen, it just kind of leads me to the conclusion that the money printer gets fired back up and there's some form of quantitative easing of the Treasury and the Fed in cooperation to buy U.S. Treasuries to put downward pressure on the longer end of the curve. Because we have so much debt, we can't sustain the debt payments. And I feel like we're really in a fragile place. I'm optimistic. You have AI that's, could be deflationary. You have like a lot of factors. So this is a pretty complex kind of situation that we have in conversation. But I think just boil it all down to the listeners, we're like watching this pretty closely. Like, and because we're in contract to buy a deal and we haven't rate locked yet. And so
we're getting squeezed, just like everybody else on that front,
I got to make one comment just for our listeners, because I know we've got a lot of people who watch all the shows. Iran conflict was not on my bingo card. At the kickoff of the year, we were like, what do we think is going to happen? I'm like, this is going to be the golden age of America. I was really pumped, and I did not expect that, and pretty shocked that it's gone this way. So I just want to put that out there that I do recognize that my forecast on this year is shot.
It's hard to leave room for certain elements of the unknown. This is a big unknown. And it's a meaningful impact, on markets in general, how things are moving. The velocity of money is like my theory in like where I gather my data and try to understand where the tea leaves are going on treasuries is that this dynamic is causing a big liquidity crisis to where countries, companies, everyone's going to need more money. And so depending on how they hold their reserves, they're punching out of reserve assets in order to move and make other strategic decisions to plan accordingly, whether that's buy things from different providers, whether that's, oil or fertilizer, all those things. So it just seems like there's a lot of movement on the capital front of reserves, which is swinging the needle on treasuries and gold and everything.
Yesterday, I believe the Daily Wire had the head economist from the Heritage Foundation, and he was talking about a lot of countries now are using their oil reserves, and so even even if it was to switch on, the problem isn't just that the supply is going to be hit right there. They're also going to be recouping what they've taken out of reserve. So it's just you touched on fertilizer. A lot of the effects are kind of a ripple that's going to push into next year, unfortunately.
And I think too, like that's what's going to be so crucial this summer as we go through, because people travel. This is generally like the summers when oil prices just cyclically always go higher because of just demand. And so as people are traveling this summer, food prices, all of these things, if that starts to continue to tick up, you're going to get these higher CPI reports. And how is the market going to digest that information? Are they going to start pricing in that the Fed's going to start to hike rates? What is that going to do to 10-year and 30-year treasuries? And so it's like all of those factors really are going to come through, I think, in the next 6 months of just what ultimately ends up happening, as well as I don't think anyone has clarity on what is going to go on with this war. At least I don't. I mean, it's the ceasefire right now.
No one does.
Yeah,
no one does.
It just kind of seems like Iran is digging their heels in, and we've seen this, I think, time and time again with just other wars. If you just go all the way back to like Vietnam or just all these other Middle East wars that we've had, it's like it's not as easy to just like go in and accomplish the mission and get out. Like,
So it's a deeper. If you hit the beehive, it's nice if you can see the whole beehive. This is like deeply embedded in that region.
Yeah,
where you don't know how big a boy the whole side of that world is. Like it's a whole thing. Where I think he's gotten a little bit over his skis. And
Lieutenant Commander.
Well, I mean, it's interesting just because short answer, we have to see what plays out. Nobody knows truly what's happening, what's happened, or where this is going. If you want to do if it's a boxing match or scorecard, I can confidently say we've delivered more blows than we've taken. But the problem is now there's this massive power vacuum. There's a massive oil vacuum and energy vacuum that needs to get filled and will get filled, right? And one thing that needs to play out, obviously Trump was in China this last week. My understanding is, big goal of that is like, well, China gets 50% of their oil from Iran. If we can pivot that relationship off of Iran and Middle Eastern oil to us, that'll obviously help us shore up a lot of our needs and our ability to export, which will help, shore up some issues that we have on our end. But then also there's a lot of, inside the military, there's this thing called the Davidson window, right? That you hear talk about, which is the old Fleet Forces 4-star Admiral, Admiral Davidson, who talked about China's growing demographic problems and their own. So we have our GDP problem. They're at 120-ish% interest to GDP. Well, China's at 300%, right? So if we're in a horrible spot, but fortunately, and also somewhat unfortunately, because we're all in bed together, that our adversaries are in a much worse spot, right? So it's the least of, but needless to say, if we can get this, our, oil and water relationship with China to kind of smooth over, and then we can kind of isolate, Middle Eastern adversaries to keep them on their own island, and we can shore up that end. I mean, it doesn't solve every problem, but it solves a lot. Granted, I don't know, who knows what Xi Jinping is going to do, because they're not exactly rational actors when it comes to their number one goal is maintaining power in the Chinese Communist Party, and they may not be able to do that with us and the power that we control. So I don't know.
So somebody said to me the other day that they thought that most of the Iranian people would like to be free of the IRGC.
Correct.
Is that true?
It seems to be the feedback that I get when I talk to people from Iran
that are here.
Yeah. But I guess that might be a different segmentation. And I think just to put something in perspective in this conversation, when I've always thought of Iran in my head, I'm like, oh, it's just another Middle Eastern country, somewhat smaller. It's giant. It's over 90 million people.
Yeah.
So it's this concept of we're just going to wipe out the top brass and get out of there. It's this is a giant country. This is a serious thing.
There's, and once again, I'm not going to claim to be an expert on how people, everyday people like us in Iran believe, but there's aspects of truth and falsities to that, right? You have Kurds, you have Shiites, you have Christians. There are pockets of each one of those who more align with Western values, and then obviously pockets of those that strongly do not. What I'm not sure is what's that breakout.
It seems like the culture of the government is really deep rooted.
Yeah.
To where even if you take out the top, it doesn't just turn over.
Yeah.
They're on TV training people how to properly use an AK-47.
Yeah.
They're all and there's a lot of committed IRGC people. And then they're of course going to be looking at it, probably potentially propagandized against the US. But it's do they want what we're selling?
Well, and also I feel this concept of we're going to take out everyone that's running the country and then make there's nobody to make a deal with. And then the people that are left, if you put yourself in that position, would you want to do a deal with someone who just killed everyone? Right now, to my understanding, they're trying to deal with someone who's one of his kids, his wife, and his father was killed by our government. Correct. So it's what type of negotiation?
Yeah.
There is no foundational relationship to negotiate upon in this scenario. It's it's just a lose-lose negotiation.
And I think too that this is important. Yeah, it's a great point. But it's this is what's important is that we have this ticking clock a little bit on inflation and the Treasury and everything like that. It's more of an economic war that they know that they're kind of imposing.
Yeah.
And so it might push Trump to either do one of two things: really step up the war in a really big way, whatever that means, right? Hopefully no boots on the ground, because that would be a disaster just with how treacherous and large Iran is, and just the loss of lives that we would, both sides would experience. But we kind of have like Trump is kind of on the clock in a sense. And then they know that they're kind of waging economic war. So I could either see one thing, him stepping up the war, or two, us backing out of it and trying to, basically save face and say that we won, but we just can't sustain it. And then Iran then takes over the strait and starts charging tolls. And what does that do? But I think there's always good and bad. So what I wanted to go to next, right, is like, okay, because of this is happening, other things are happening here at home. And one of it is that a lot of people are headed to the Gulf of America, if you will, and they're filling up on liquid natural gas. And like one of those main areas is Houston. And as obviously we're digging into Houston a ton and have been spending a lot of time out there and in the market, it's amazing that more natural gas is moving out of Houston than any other port in the world.
Yeah.
And it's exponentially growing because Europe needs this liquid natural gas because of Nord Stream that got blown up with Russia. And so I do think that short term might be pain. I don't know. I hope not. But long term, geopolitically, I think that we're putting ourselves in a really keen position to we have the resources here. We can start to export. That puts further strength on the Treasury and the dollar, because then people have to buy Treasuries and convert to dollars to then trade with us. So who knows? I think that it's not all bad, right?
I think where you're hitting on is the macro, the general. The issue is, I forgot what the number is, but it's something like, I think it's over 50% of Americans have less than $500 in their bank account right now. And when we have a doubling of gas, like that is directly impacting the masses.
I have some very, I'd say productive and higher income earners, people that I bumped into, and they're complaining about it.
Yeah.
I'm not driving my truck now because it's too expensive. It's like, even if it's they can afford it, it's a mental shift in momentum that 100%. Occurs in the market. So it's interesting.
Yeah, and then I'll show up at the ballot box.
For sure.
Yeah, so I think that's the big thing is where does this go if we don't, I feel like Trump's almost trying to smoke them out, leave them on the front burner and see what happens.
Yeah.
But this is I've heard it also referenced as a game of chicken.
Do you guys think there's going to be a pin that pops this balloon?
So then let's shift over to the markets, because I just think that is so interesting how many people are confident and or willing to continue to play in the equity markets to the level they are at now.
Two things real quick. Just number one, before we leave China, I just want to make this one point. One good thing about our relationship with China is they're completely dependent on the American economy. Mm-hmm. They really are. And so that is a net benefit in this negotiation, where we actually have substantially more in common with China than China does with Iran, besides them being a gas station for them. So just something to say on that.
Yeah.
Now, as we get into this market conversation, we talk about the pin and the pop. During COVID, we felt a 30% dip in the markets, right?
Mm-hmm.
Yeah.
I remember watching it on the news.
So we've been in one of these scenarios. So when we talk about the pin and the pop, what do we mean? Because the 30%, it's terrible. We don't want to see it. But when I hear pop and a balloon popping, in my brain, I go to 1930s, Grapes of Wrath, the Dust Bowl.
I mean, COVID was like that, though.
COVID was as close.
As they were doing massive shutoffs, work from home, lockouts, everywhere, internationally, you're watching it. Just live on the news, watching the ticker drop 5%, 7%, just continue to plummet right before your eyes.
I don't think we had the same economic hardship that we did in the 1930s, where we had I don't know what the unemployment rate was in America, but it was drastic.
Mm-hmm. No, I think what his point is, that's the closest thing in our generation, let's say, that you could feel and point to.
Yeah,
100%.
Which I agree with you though. At some point, we're cash flow oriented real estate operators. I don't understand the PE ratio dynamics of betting all that money on the future growth of companies when where's it going?
Yeah.
Well, most of the growth of the equities right now is all tied up in AI. It's the
so
top 4 or 5 companies are driving.
It's basically, I just read a stat that 20% of the S&P 500 right now is made up of semiconductors. The last time they had this high was in the .com bubble.
Yeah.
So
Treasuries also spiked.
Yeah.
So we're headed towards a realm. If the nature of treasuries is basically sold off and more people lean into equity, meaning treasuries start to come up and balloon, we're in .com era. There's another moment in time that aligns to, I think it's in the 70s.
Yeah. Well, I think too, just going and talking about the market, just to put some context on it. Like there'll be a catalyst, right? There'll be something that then just spooks the market, and then it has a perpetual effect on itself as people start to see that the market sold off 5% the next day, it sells off again, and then it can sell off again. And then just like an interesting thing to note, and the NASDAQ, the S&P, the exchanges have a limit. So like if a market sells off 5% or any given stock, but like if the market sells off, they'll stop trading. And that there's a couple of limits. I think there's 3. So say it goes down 5%, stops for like an hour, 30 minutes, something like that. And then it'll reopen. And then if it goes down like 10% or 5%, I forget exactly what it is, then it'll stop for like an hour. And then if it goes down further than that, they'll stop it for the entire day. So they do this, they put these limits in because I think one, like just algorithmic trading, it can kind of like feed itself, like AI trading now. Like a lot of people are just trading, just using AI. So it's like the robots doing it. So like the exchanges, I forget what
they're all going to sell off at the same time.
Yeah, that's what I mean. They just don't want it. They want to make sure like rational heads get involved. And so you won't see like a day where it's impossible to see a day where it could sell off like 50% because of these regulations that they put in, these stop measures. But like COVID was a really good example because those were in place. It would have sold off. It sold off like 20% overall, 30% overall. But like I think the biggest day was like 9% or 10% in one day. I remember I was sitting on the trading desk, like I was sitting in BlackRock, just looking up, and no one's around because everyone's like, "You gotta leave." I was watching the TV, like, "Holy shit!" And it was like a vivid memory in my mind. But what Heather was talking about on Friday, which I just think it'd be an important note, is that like if you spent the last 40 years of your life generating your wealth and you're sitting on a lot of money in the market, and if it goes down 40%, or let's just say 40% for easy math, like what she's saying is like it would need to go up 80% for you to then get back to the levels that you were, and the amount of time that could take and potentially would take, like you don't have those years anymore. And so she talked a lot about like diversification and like why she loves the manufactured housing investments that we do, and she puts her clients in it, many of which are like billionaires and super high net worth, sophisticated family offices, because she's intuitively understands that it's like, yes, over the 10 years, if you bought at any 10-year moment and looked up in 10 years, like the stocks are probably going to be higher than where they are today. And it's probably the best place to compound net worth over time. But it doesn't always work out that way because we don't live forever. And people that are sitting in their 60s, they don't have a ton of time on their side. They want to take all the net worth that they've accumulated over all those decades of working really hard, and they want to protect it. And so that's why we really lean in, and maybe it'll be our next point of just like, okay, if there is a recession, why? I mean, this company was built out of the recession. 2008, 2009 is when it started. Like, this is kind of why we invest in these assets. And we've been in a 15-year bull market, 15+ year bull market. And so everything's gone up. But if things shift, why do you think, Blake, like this is the best asset class? I know you have some data to back this up to be in for that capital preservation, the income, but also just maintaining purchasing power.
Yeah. So internally, what we're trying to do and what our objective is to share is, what do you want to be in if things do turn? I mean, even just with the additional cost of living, let's say the market just kind of continues, right?
Yeah.
And you just end up paying $6-8 a gallon for gas. Like those types of things start to swing the needle on what homes you get into, like what you're going to decide to how to live. So in our long-term theory, and then what we're trying to verify is our forward-looking forecast and thesis is, do we end up with a bigger swath of the demographic base in manufactured housing because we're so affordable? I think yes. I mean, that's what I was curious to. I pulled a bunch of data together and put it on a chart. Now with AI, it's so nice to be able to do that. And you can then pull it from different sources and kind of clean it and fact check it. And what's interesting is it is true, historically speaking, since the space materialized and call it the 60s and 70s, the demographic and so our demand for affordable housing continues to grow and basically grow enough to offset the downturn. You are able to stay and operate, and maybe you don't get to raise rents or increase revenue, but you get to hold steady through the times when multifamily goes, double digits.
Well, what's interesting, you get to maintain occupancy at your rent levels. That's the key part.
You're not seeing softening.
Yeah, exactly. Because if you're in an A class, you're in an A class, then you drop down to the B class, right, or the C class, where we're the last rung of affordability, and it's a fixed. Basically, it's a fixed supply. Like there's only 43,000, I think, if you look. Mobile home parks in the entire United States. Last year, 2024, 650,000 units. So these aren't apartments, but units came online in apartments.
Yep.
So like just that asymmetric profile of just like growing demand, like what you're touching on, but then I just wanted to cover the other side, which is supply. You have a fixed rate of supply, and it's the last rung of affordability. And the last thing, and I'll hand it back to you, is you touched on it, but just put in some color of a stat. In 2008, which was way worse than COVID, mobile home parks across all of the real estate asset classes was the only real estate asset class that saw net operating income increase during that time. And it's been the best performing real estate asset class over the last 40 years. But it's because of what we're talking about. It's like, it is that demand, it's that fixed supply, and it's the last rung of affordability. And the tenants, they own their home. I think, it's like.
And the quality of life dynamics is still really good and there. It's like, it's a very fair option given how less expensive it is. So that's really where, as a fun data point, as we're operating these communities, you interact on the home sales and the home leasing on some of the new homes we end up with, and then we work to sell them off over time because we want to operate land lease only communities. But what's interesting is we seem to be selling off like the $30,000 to $40,000 homes that are used that we end up with as inventory, and then we just clean up and paint and skirt and just make them nice again and resell them. We have a ton of demand for that.
Mm-hmm.
Those are the best. That's like the most consistent way for us to keep our mobile home parks full is to sell the used inventory back in.
A couple things. I did a little spreadsheet just to kind of look at numbers. So during the Great Recession, we had 10% unemployment and a drop of about 5%. This is what it's saying in GDP. COVID, obviously a larger drop, but 14% unemployment rate. So COVID and 2008 actually pretty similar in the effect. I think one net positive today versus the GFC is during that time, there were a lot of chattel loans that went under, and there was a ton of repossessions. But since Dodd-Frank has come in, there's a lot less of these predatory loans. Like they basically don't exist.
Well, we are in the game now on them. Like we own the inventory or we're backing the inventory.
Correct.
So it's very different.
So the chance of, 20% of your park potentially moving out of some of these higher quality assets isn't going to happen. I think it's even more insulated now.
It's a great point. And then why I think, and that 2008 was a lot worse, even though that unemployment number in 2008, that was more like even when you got to that 10%, and we could ask AI and run these numbers, but if it was more longer, like that unemployment rate stayed elevated for longer, right? Even though it was 4% less, 14 to 10, where COVID was kind of like a blip because everyone had to go home, right? It's like, okay, if you work in a hotel and you're the front desk, well, no one's staying in a hotel or I don't know, a restaurant, but it bounced back up really quickly. And they had the playbook from 2008 of quantitative easing and just everything like that. And they pumped a ton of money with the PPM or whatever, all these, not PPM, PPM.
What do they call it? Helicopter money.
Helicopter. They were just flooding money into the system so quick. Yeah. And that's kind of why we're where we are today as well with inflation and our debt, 35 trillion. I mean, the Fed's balance sheet has expanded exponentially since COVID. It's insane.
Yeah.
The other thing too, between the GFC that COVID can't relate to is a ton of people lost everything. in the GFC. And like obviously COVID was a recession, but that wasn't fueled by bad paper, mass foreclosures, like homelessness
and like
spikes,
basically
fraud, like
on why you should be
completely-
able to have 5 homes that you don't have the income to support. You know, it's like weird.
Yeah.
That was weird.
Yeah, whereas like COVID was like a suppression, but like GFC, the rug just got pulled out and people lost everything. So it was a much longer recovery than COVID snapback as like the suppression started lifting and people started returning to work.
And just for talking about the balloon pop, the Great Depression was a 30% GDP decline, peak unemployment of 25%, and it was from 1929 to 33. So just to kind of give like that, when I hear balloon pop, that's what I think. I don't think a 30% dip where unemployment doubles.
Well, and they didn't have the tool. They didn't have the will to be as crazy with financial policy back then. Developing the systems that they have now, it's so sophisticated. But basically, that's a nice way of saying they have the ability to bring currency online quickly.
Yeah,
and I feel like the pain tolerance is way less on how they look at market cycles, and then they're just going to come in and hammer more dollars into the market.
But I think that like the complexity now is what Blake's talking about is just how much they've expanded. So we have like 35, I don't even know, I think it's like 35 trillion, right? Just like big round numbers. We spend $1 trillion right now on interest payments, which is our largest cost item over Medicare, Medicaid, Social Security. It's the largest item. And we're running a deficit. We collect like 5 trillion and we spend on a given year 7 trillion, with that trillion on the spending side being just interest payments. So this is why, like, if you're tying it all back in, this is why the Treasury going up and all of these things, you know, and costs are going up. This is why it could be much more dramatic because of the fact that the Fed and the government, if they don't play this right, they can essentially, and this is, I'm not saying this is going to happen, but they could essentially lose control. And where you have inflation run and you go into a stagflation environment. You have basically low growth, so GDP falls off, right? You're not pulling in as much revenue, but then you have inflation that's ticking up, that's making everything more expensive. The Fed has never been in that scenario, and that would be one of the, you know, there's times where people have gone back and looked, I think in like the 70s or 80s, there was like stagflation environments, but like I just never with the balance sheet that they have now with the amount of debt compared to GDP, what you talked about.
So I have a clarifying question. So when you former Wall Street people like you and Heather are talking about these things and you're talking about a balloon pop, what are you guys saying? What do you feel? Do you feel like it's going to be a 1930 scenario, or do you think it's going to be a Great Recession COVID scenario?
I don't think we weren't talking about a balloon pop. I don't think that you never know where it's going to come from. It's going to be something, right? When it does, it's always, yeah, exactly. It could be a tweet, but it's just like if in like 2008, like when everything really kind of sold off is like once Lehman, like it got announced at Lehman. So, I mean, there were so much bad things that were going on in the market that were just kind of getting delayed. Like, oh crap. Like, no, these banks would never go under. Like even Heather was working at JP Morgan. She was telling that story. And she's like trading some of these bonds. And she was like, I don't want to be, these things are worth zero. And they're like, there's no way that the US government is going to let a bank go under. And then when they announced that and they let those go under, that's when everything crashed. That's when all the dominoes came down. So that's kind of like that balloon pop. I'm just trying to give you a catalyst, like where like there's stuff moves.
Right now there's a lot of speculation that commercial, like private credit could be that canary in the coal mine right now.
And I just think it's a small portion, but that could be that little like, and then it snowballs, right? Because then everyone sells off and it's perpetual, right? And then it like kind of causes.
So you don't think, in theory though, you don't, I don't think it's going to be as bad as. Like
that's what I'm trying to feel.
I don't think so either. I think personally what's going to happen, this is my personal opinion, what I think is going to happen is that something will happen that's then going to cause them to install some form of quantitative easing, some treasury manipulation.
They're going to call it something else.
Yes, where they're going, like I never underestimate like just like monetary policy. And I've brought this up to you guys a lot. I think the best thing that I got from Ray Dalio's book when I read it was that he was talking about the LATAM debt crisis back in whenever it was. And he was like, he was right. He was right, but he was wrong because he didn't price in the creativity of central banks to be able to
Print more money.
to collaborate and essentially and basically save these entities, right? And he lost a ton of money on that.
He shorted, right?
Yes.
And I think that was in the 80s, early 80s.
Yeah.
And he shorted the market, and then they came in with monetary policy and smoothed it out, and it melted up.
Yep.
The market melted up. And so that's actually what a lot of people are talking about now is, are we going into another melt up? Because that's where it's like, I don't understand these, like the price per earnings on a stock share. It's like, what?
Yeah.
How can you make sense of this? And it's like, everyone's just like, well, we don't know what to do, so we're just going to stay in the markets.
Yeah.
And then now we got these AI bots trading billions of dollars every day. It's just like perpetuating this growth dynamic. And everyone's betting that the government will just smooth the edges off again.
Yeah. And that's what I think is going to happen. So what does that ultimately mean? Like, what that means is inflation is going to be around for a lot longer, right? So you need to be in assets, right? Because if you're not going to be in assets, then you're going to get left behind. And I do think that there will be some sort of like melt up. So like it might crash, right? It might come down like 20%, or maybe it doesn't at all. Maybe it's 5% and just
call it a correction.
A correction. There's going to be some people that step in. There's going to be a big announcement, quantitative easing, bringing down the Treasury rates. The asset prices are going to balloon again, and
credit availability is key, though.
Yes,
and they have to figure out treasuries.
Exactly, and then,
or everyone's gonna be taking floaters again because of SOFR.
But like if we play this out, in my mind, what's the worst case is like this K-shaped economy gets even worse, and there's the haves and there's the have-nots, and it's like a political revolution. Because you know what I mean? Because people that own assets are going to continue to do very well. People that don't are going to continue to get squeezed by inflation.
But then there's an argument to stay in equities, in essence.
Yeah.
And
good equities. You know, like make sure you're not over the top with AI or whatever. But it seems like inflation will help that.
If you have time on your side.
If you have time.
So that's a good segue into a conversation I had this morning with, one of our investors who came to the summit, and they're talking. It's like, I found it very interesting just looking around the room, like how, and this person was like, I was one of the younger ones there. And I was like, well, yeah. I was like, we are the best defensible real estate asset out there. And we talk about asymmetric returns, where it's like, okay, you have your core plus, value add, development, more risk on type return profiles. Well, we solidly, like very confidently hit these value add type returns with a core plus type risk profile, right? And so when you think about that investor who needs to preserve capital, maintain cash flow because they're fixed income or getting towards the end of their career, that's why in a very, all the things we've talked about, a whole bunch of stuff today, underlying theme is uncertainty. Like nobody knows what's going on, what's happening, what's around next week, next month, next year. But if you are in this time in your life where you need to be more risk off and have a sure thing, that's why when there's so much uncertainty in the market, we've never raised capital. Like raising capital is not easy, especially in a time like this. And we've never had an easier time doing it just because of the inherent asset class. Obviously the track record, the team, like there's a lot behind it. Ops, like we never, no capital calls, never lost investor capital. But in a time like this where it inherently should never be more difficult to attract capital, we have never attracted more.
Well said.
Agreed. Yeah. And if you want to watch the entire investor summit, we have a nice edited version on the Investor Circle. So join just with your email and log into that, and you can watch the whole event. I just want to miss that because that's huge. And it was a very valuable event. A lot of great context was shared. So it's worth checking out.
Yeah.
But yeah, people, there's no lack of demand for certainty in a lot of uncertainty, so, and we do have a lot of certainty in just, we're not swinging for the fences, and then along the ways, if you are paying taxes and we can add value on kind of shaving off some of the friction costs on the tax front, why not? You just double down to like, they know they're going to pay taxes. They know we can collect and pay a nice dividend. That's just fair.
Yep.
It's like, we can add a lot of value and bring that certainty in because there's so much movement.
It's crazy. It's hard to keep up with. It sounds like this Kevin Warsh guy is pretty sophisticated and going to be maybe a net positive to the markets. What do you think?
No, I agree with you. I think so too. And I just think that the Fed has a dual mandate policy. The Fed's never been more divided than it is today.
Does that mean they have a board and they vote?
Yeah.
Okay. I just want to clear that
And I
up.
believe the board is all of the presidents of the different centralized banks.
Correct. Yeah, exactly.
Sounds like a fair deal.
So is it more divided because of just how politically divided things are, or is it just more divided because of just how hairy the economy is right now?
No, it's just so it's not one person's democratic, and because it's not part of it, quote unquote, the government, right? It's supposed to be independent, and so there's different Fed chairs that sit in like San Francisco, like Chicago.
Are they all independently elected?
That's a great question.
That just dawned on me.
No, they
Look that up.
they get appointed by the president. Confirm that.
City?
Yeah,
Like the New York Fed.
I think that's the case.
Fed.
They get appointed by the president, and they serve a certain amount of years.
President of what?
The United States.
Oh, I doubt that. Let's see that.
Leaders of the Federal Reserve are appointed, not elected. The 7 members of the Board of Governors, which include the chair and vice chairs, are nominated by the President of the United States of America.
Good idea.
Hey.
Well, hey, I had to study this stuff, so I should be able. I should be able to know.
Confirmed by the Senate.
Yeah, confirmed by the Senate. So
Okay.
Yeah.
Wow. Okay. So they're not necessarily bank involved.
Usually they've
They
worked
are.
for the banks.
they are.
So
Yeah,
is that like
and
a
then,
prerequisite for them to be able to get that job? Like,
yeah, I mean, exactly. It's like
gonna say
they're
something politically
economists. They're economists. So they're like they're PhD economists.
is that a job though? Like, do they hold a regular job within a banking?
No, that's their full-time job.
Okay.
Yeah.
All right. Interesting.
And so and
Yeah,
then-
you learn something new every day.
yeah.
They almost always vote completely unanimously on decisions made. And I think what you're referencing now is like for the first time we're seeing like multiple people
Well, now you're
stepping
getting
out.
into changes of approach, right? Like,
Yeah.
do you increase rates and let them run, or do you put downward pressure on SOFR, which is their toggle?
Yep.
That's their control.
But it seems like they've got a lot. Like, why don't you expand upon this? Because we just went through a Fed chair who really only used one button, but it seems like we're talking about imagination and creative uses of the Fed and monetary policy. Like, what are some levers that they have that they can pull that maybe Kevin's going to utilize?
Well, they can do like things that they did in 2000 and in that 2000 era, like 2008 to 2012, like Operation Twist, which and this is real. You can look it
The
up.
twist.
Yeah, Operation. Like this is one component, right? But they were selling the front end of the curve and buying longer dated treasuries to bring down longer dated rates. So yeah, they have so many things now. So obviously they have quantitative easing. They've expanded their balance sheet where they don't even just have to just buy treasuries. They can buy mortgage-backed securities, CMBS, ABS. So they're not limited on those types of things. Yeah. So and then they're constantly getting like new tools. So like I would like to see like, personally, I think that it's going to be some sort of form of like operational twist where they're going to start buying longer dated 30-year, 10-year bonds. And then I think they'll probably sell off the front end of the curve to start to like flatten the yield curve to a certain component. Mm-hmm. And then obviously they can cut, which everyone knows, they can cut the Fed funds rate, which is what he's like that SOFR pegs off of, which a lot of people use for like floating rate or construction rate debt, shorter term debt. But yeah, so like I think that's what I mean. It's not just cutting the front end because it has nothing. Because you just can cut the Fed funds rate that has no manipulation on the 10. It does. They're all correlated, right? Because it's kind of is a prerequisite of like where the future rates are going to end up going, or like if they start cutting the front end of the curve.
It's one of the factors that drives demand or pulls demand.
Yeah, but they can buy longer dated bonds and hold them on the balance sheet.
Which is, I mean, that's like so far out there into like market manipulation. It's pretty wild.
It is.
They can do that.
But like to Morgan's point, like China does this, the ECB does this. You know what I mean? So it's like
I like to go back to the point that no nation has ever done it correctly, ever.
But if we all do it,
that's the interesting point.
Yeah.
Everyone's doing it.
yeah.
And we're actually one of the best economies, like from a stability standpoint. We're talking about debt. We're talking about these things. Like who are we talking about? Just to put some things in perspective, the UK right now, their GDP is lower than our 50th state. Okay. They are worth like 2.5 trillion in GDP. Nvidia is worth 4.5 trillion, right? Like who are we talking about? Like,
well, that's where like I feel like there's a lot of New World Order things
Shifting,
where it's not like the conspiracy New World Order. It's like the world order is shifting. And I think that's most likely the data points that Trump's focus on in his head, whether that's right or wrong, to be determined. But like, I feel like he's trying to solidify America as the
sun. Everything rotates around us
as the main force still, and keeping the dollar in circulation and people with treasury, or the countries with treasury demand. One of the really interesting points that is important to hit here, which I'd say it's probably the best point I've heard in the collection of news and data that I listen to, is we need credit availability to flow.
To 100%.
And check this out. Pull this. I don't have it off the top.
I do want to make a correction. I saw this on a reel, and that's where I reference it. I'm wrong. It is not, Mississippi does not have a higher GDP than the UK. But to put it in perspective,
that's pretty wild.
I just saw that. That's so sad.
Losers.
Mississippi.
But like Vermont's bigger than the UK?
I know, that was confusing.
Well, I'm getting different data from AI right now because now it's referencing the UK at 4 trillion, where it said before it was 2.5. But anyways, it's 4 trillion versus America's 28 trillion. To give you perspective, all I'm saying is that we're such a stronger position.
Larger,
what were you going to ask me to search?
So the key is you got to get money in people's hands. So like even if they print money, and this is where it's like it's kind of difficult for Main Street to understand because it's pretty deep. If they print money, that doesn't just automatically correlate to 1-to-1 inflation.
Correct.
They have to put the money out.
And circulation.
And they've become less and less capable, or whatever you want to call it, effective at deploying the capital.
That's interesting. Why?
So banks.
Send it in the mail.
So this is the search. How many banks, or the total number of banks in type in 1950 to today. The number of credit unions and banks has shrunk in by 100 times. So it's all a consolidation of the banking. So then it's the banking policies. And so, so then you want to be, from a defensive standpoint, which is why we had the debt panel during our event, you want to be considerate of if your business has credit available to it.
Correct.
Just in case, right? If we ever need to refinance or do something because, we need to spend a little bit more money on this property, you want to be able to borrow money if it's required, in your business.
And that there's demand to have that as a, call it collateralized piece, which mobile home parks, the banks, the insurance companies, they love it.
You want to understand collateral, and you want to understand if your business has collateral. I think there's a lot of push to go into the service-based businesses. Like we were chatting with a friend yesterday that SBA loves small businesses, and those types of businesses specifically. So you want to understand the credit availability for your space. But with that said, so how many banks? What's the data?
Do we want to put a guess out there on how many there were in 1950?
Oh gosh.
I don't even know.
Give me some context. I have no idea.
Let's just give you the
digits?
number
How
for
many digits?
1950. It was 13,446 banks. How many do you think there are now?
There's less than that. There's probably 1,000.
6,000.
3,800.
So it's neck
So it's
down.
dropped 10,000 banks.
Yeah. So it's gone.
So-
Is that more towards M&A or going under?
it's just basically
They buy them.
They buy them.
Both.
They-
I think
both.
Every time there's a savings and loan crisis, a 2008, a .com.
Yeah, you
happens
trim the
is
fat,
these-
trim the fat,
Well, this is what's
consolidation.
kind of well, what happens is these small
the
regional
spaghetti, eat the
banks,
vodka.
these small regional banks that they know their consumer. They're in let's just say a smaller town or city, right? They know their consumer. They know they understand the businesses around there. They would go. They'd have their deposits there. They'd go there hey, I'm a farmer. I gotta getting ready for crop season. I need to start planting. I need a $500,000 loan. Okay, Mr. Johnson, I understand everything you're doing. You have money here. Boom. They provide so much more liquidity, right? Then what happens is that there's a recession.
Everybody
the big banks get bought out, right? They're the quantitative easing. The basically the Fed is buying their assets, because on a bank's balance sheet, a loan is an asset, right? It's a liability to the borrower. But then these small banks can't survive. So then what happens? Then they just basically, that bank that's Omaha, Omaha Financial goes down and it turns and it's JP Morgan Chase.
I was gonna say, I love the kids version of the farmer and that in Omaha, but like, dude, First Republic just got snapped up. Like
all of the tech side in Silicon Valley Bank. I mean, Then you have the dynamics of market manipulation. Whoops, sorry, banks, you were holding all your money in treasuries. Whoops.
Longer dated treasuries.
And so their treasuries went in half, and now they have massive obligations that they can't repay. Like, you just have. So I actually think it's those big moves and regulatory. So where I was going to go was, I think they make it more difficult from a regulatory environment for the small banks to exist. Meaning, like, you have reserve requirements, you have all these different things that until you have scale enough, it's too costly to operate.
Correct.
Mm-hmm. So that's another key point, is what regulations have changed for banks that have created that bottleneck, because it's obviously not a business that can be sustaining. Like, we would start a bank, if it's easy enough, and
it's like impossible now, to my understanding. It's pretty tough.
There you go. And so that credit availability is the key to growth. And it's what there was economists in the day that knew that, and that was when it kicked off all the banks. And now we've gotten away from that, and which is leaning more towards like a dictatorship, top down from the Fed dynamic.
Well, like, go walk into a Bank of America and go get an SBA loan or a loan. It's like, it's like impossible. It's like, I mean, I'm not saying it's impossible, but for a lot of people, they're like, I want to start a business. You have to go to these. It's impossible, which is a shame, where like you could build a relationship with a small regional bank, right? And and grow a business.
So just curious, during COVID, how was debt availability from Fannie and Freddie? For us.
So that was because it was like a disaster, call it, just an unforeseen, non-economic, it wasn't something that economically happened. So it was like the engine was running, and then everyone got into fear, and it was what they called a disaster relief kind of dynamic.
Oh, so it was like helped by the government.
Well, so everyone was really willing to deal with like payments and structures, and we didn't ever have an issue, but I've heard several different angles that if we didn't collect rents or something happened in those moments, they would just put those payments that you missed for probably up to a year on the back end of the loan and do a loan modification. So there was pretty good elements of on the servicing side. Mm-hmm. But when you wanted to buy properties, it was pretty difficult. And like we bought some properties where they had COVID reserves, and then they just sat, for years.
Yeah, we got one where
they made it really difficult to get those reserves out. And then we didn't necessarily need them for the cash element anyways, but like there was some meaningful moves where they made it more and more difficult to borrow. So I'd say you have to kind of be now more sophisticated to borrow money.
In groups that don't have scale and are required to do deals in order to survive, that's where this type of thing thins the crowd.
Which then does sort of create this weird valley between the haves and the have-nots. Like, how do you jump? And how do you become an entrepreneur and jump today? It's becoming harder and harder on the side of understanding and becoming economically sharp, and connected. Mm-hmm. You need to be more intentional now.
I agree. Why don't you close this out, Blake?
All right. So thanks for joining us. There's a lot of interesting dynamics in the market. So all we're trying to do is add some value and share some insight. So thanks for joining us on the Cash Flow Quest. We hope you have a great rest of your day, and we'll see you next time. Cheers.
Thanks, everyone.